This is Debt Free in 30, where every week we take 30 minutes and get practical advice from industry experts about personal finance and living debt-free. Here's your host, Doug Hoyes.
Today on Debt Free in 30, we've got a lot to discuss. My guest today is a certified financial planner, and on her website, she says she likes working with clients who have more goals than money. She has a particular interest in helping young families make a financial plan, so we'll talk about that and lots more on today's show. So let's get started. Who are you and what do you do?
I'm Sandi Martin, and I am an advice-only financial planner.
Advice only. I think that might come up later on. So let's start with some history. Tell me about your life as a banker and then what led you to start what is now called Spring Financial Planning.
Right. I was a banker for about 9 years. And within the first year, I realized that I probably shouldn't be a banker because it's difficult to do a really good job for your bank manager and for your clients at the same time. And I like doing a good job, and that gives me angst. So I had a really good bank manager in my middle years when I was in Huntsville. Her name was Shelley Crozier, and that doesn't mean anything necessarily. Nobody knows her, but she gave me a copy of the Wealthy Barber Returns, and it just blew my mind because it was totally different from what happened in banking. And so then I formulated a plan to escape banking as rapidly as possible, and I moved slow, so it took me 3 or 4 years.
Wow. And so that's how you started. It wasn't called Spring Financial Planning at the start.
No, it was called Spring Personal Finance at the start.
So it's a totally new name, new brand, new everything.
Totally. Mm-hmm. Night and day. And
what was the big problem with the bank then? You said you were there for 10 years. After the first year, you figured out that, and then it gradually took a while to find the exit. So what was it that did not make you happy there?
Well, the end goal to be a successful bank employee is to sell as many profitable bank products as possible without running afoul of the regulator or the compliance officer. And so the sales team meetings were all about, all the wording, all the training was about doing the right thing for the client. But on the other side was, but also the thing that gets them into equity mutual funds or the thing that gets them a secured line of credit.
So you're saying bankers are salespeople? Is that what you're telling me here?
I
can't believe that.
I am a terrible salesperson. So now the cat's out of the bag.
So, and that was really the problem if I understand it correctly, you get some kind of, check mark on the personnel records, or you get a bonus or something if you put someone into the mutual fund. But if you show them a way to pay out their mortgage a year faster, there's no pat on the back for that.
That's exactly right. There's a compensation matrix, right? So I was paid a salary. I mean, everybody does it a little bit differently, but where I was paid a salary, and then I had my performance review. And the things that went into the performance review, there were some soft things that were all supposed to be around what I said before, what's best for the client. But all of the quantitative measures were how many dollars in mortgages did you sell? How much used line of credit dollars went out the door from you? How many equity mutual funds? And it kind of, there was the dollar value and then what it meant for you on your performance scorecard that was drilled into everybody's head. But yeah, none of that soft stuff about meeting your goals or being financially free. None of that stuff was measured. So it wasn't important because what gets measured gets
that's what we do. Compensation matrix. I like that word though. That sounds pretty cool. So, okay, so let's get back to this whole fee only thing then that you were talking about. So back on episode number 198, my guest was Jason Heath, who's also a CFP. And he explained what it means to be a fee-only financial planner. So I'd like to hear your take on that. And I think you kind of already hit the point that at a bank, you are compensated based on how many things you sell. Obviously, it's not the same when you're a fee-only financial planner.
Right. Well, we get paid based on the time that we spend with clients. So if I'm going to do a financial plan for a client, I have to tell them, here's what I'm going to do for you. Here's what success looks like, because we have to work out with the client what success will look like at the end of an engagement. And here's how much it's going to cost you because it's going to take me this long to do. That's it.
So if I come to you and you're going to be my financial planner and, here's all the things that need done, and you say, okay, it's going to cost, X number of dollars for the next 6 months or whatever. That's what I pay you. And it doesn't matter if at the end of the day I decide to put my money in mutual funds or pay down debt or buy stocks directly or whatever, you get paid the same amount regardless.
Yeah, it's solution agnostic is how I
Solution
like
agnostic. Okay, so compensation matrix, solution agnostic. I guess we've got the title for this episode. That's going to go viral. So, okay, now that's the preamble. Let's get to the good stuff here. So I want to put up on the screen, I don't know if this is going to work or not because I don't really know how to work all this kind of stuff, but let's see here. So this is, I don't know if you can see that or not, but so this is a tweet that you sent out on June the 22nd, 2018. And I don't know, I'm thinking you were not in a good mood when you sent this, so you should never tweet when you're in a bad mood. But what you said was, so... And whenever you start off with so, you know you're not in a good mood. So, since the CSA has decided that it's perfectly fine for financial salespeople to continue pretending like they're giving you good advice for you, instead of for how much they'll make off you, here are a few people to get to know if you need advice. And then you, I think, listed like 14 people. You know, there's this guy and this person and that person, and, you know, who are all perfectly good fee-only financial planners. And oh, look, there's Jason Heath. We just talked about him. So I guess he's in your good books as well. And a bunch of people jumped on at the end of that. So first of all, what is the CSA? And what is this? It's perfectly fine for, like, what are you talking about here? What got you going on this one?
Well, the CSA is who regulates investments in Canada. Let's put it really simple terms. So I'm not sure how much the listeners know or care to know about regulation of investment advice and sales in Canada, but there's a national body and then there are individual provincial bodies. And in the end, it's really the provincial bodies that matter the most. So we don't need to get it too far into it, but essentially let's talk about them as one of the regulators, one of the key regulators whose opinion matters and the direction of their rules matters to what happens in mutual fund sales and all sorts of other things. What was the rest of the question? I got stuck on that one.
There's this regulatory body called the CSA.
Mm-hmm.
And sometime around June 22nd, they must have come out with some kind of pronouncement that said you can, you know, do whatever you want. That's kind of what I'm reading into this.
Well, no. I mean, to me, that's the effect. That's the net effect of what they've come out with. But the CSA and various other regulatory bodies in Canada have been consulting on how to make financial advice better for Canadians for a very long time. So the stuff that's coming out now. So, for example, I think they had decided that they were not going to, if I recall correctly, because there's been other stuff that happened since then. I think that particular announcement was, we are not going to pursue trying to ban embedded commissions in investment products, which is you get paid, you know, the advisor who gives you investment advice gets paid because that product that they sold you continues to pay that advisor over time, a trailing commission, right?
And so this is kind of the whole key to it then. So I go out and buy a mutual fund and it doesn't cost me anything to buy it. I know if I go on the stock market and use my, you know, stock trading account, they're going to charge me, you know, $10 commission or whatever it is to buy the stock. But I can buy a mutual fund and it doesn't cost me anything. It's free. And you're saying, no, it's not really free.
Well, no. And so, if you're getting good advice, so the premise is the person that's giving you the advice about what particular mutual fund or which particular security to buy needs to be compensated for that advice because they're a professional. Totally fine. Not arguing with that. It's easier for them. The position, and actually there's a series of even angrier tweets later on, but the position of many members of the industry is, if we don't embed that kind of compensation for the professional inside the investment, if people have to pay for it directly, then a lot of small investors aren't going to get the kind of good advice that they need because nobody will deal with them because the cost will be too high. And so the swaths of Canadians are going to be without meaningful, high quality investment advice, and we can't have that. So let's make sure that these people are still paying through their mutual funds instead of any other fee arrangement, which I say is I'm not sure what words I'm allowed to use.
That you can use whatever your words. I'll bleep them out later. We're not on live TV. This is on iTunes and YouTube. So what you just said there sounds all perfectly rational. I'm just a little guy. I don't have $1 million. I've only I put a couple of $100 a month into a mutual fund. And so I don't have thousands of dollars to pay an advisor, but because I'm buying my mutual fund from that guy, he's getting a fee from the mutual fund company. Sounds like a win-win for everybody.
Sure. If you're not paying, though, directly, there's a whole host of things. So number one, if you aren't paying directly for all the different things that your advisor is supposed to do for you, how do you know which ones you're paying for and whether you're getting them or not? There's
a lack of transparency here.
Right? The second thing is, if you are paying your advisor via the ultimate product that is meant to be the solution for the problem that you came in with, nobody goes in and says, I would like to buy a mutual fund. They go in saying, I don't know if I'm going to be able to pay for my kids' education, or am I saving enough for retirement, or I just got a lump sum offer from my pension. Should I keep it, or should I take it out and invest it, or should I just keep it inside my pension? The solution to all of those is not necessarily a product, but if the person to whom you go for advice has only products to compensate them, then the solution is always going to be a product, because otherwise they're doing free work.
Yeah. So if all I have is a hammer, then everything looks like a nail. So all I can do is sell mutual funds, and that's what I'm going to put you in. I'm never going to put you in anything other than that. Well, not necessarily, but that's the risk. That's the bias. You don't understand. I think the biggest problem is people don't understand that that's how my person gets paid.
Well, and I think the other thing that people don't understand, we've all seen on the internet, like the varying expanded mind memes, right? So the first thing is, oh my goodness, this person is only paid when they give me a product. The second level is, yeah, but where can I get the kind of advice that they are giving me if I'm not paying them the way that they are able to be paid? Because I can't tell somebody, oh, this is why the reform of the industry is what's needed, because I used to be able to sell mutual funds. I have the same or better qualifications as the person who today could tell you what mutual funds to buy. But I'm not licensed to do so for lots of different reasons, many of them because I just don't want to be. But I can't, on an hourly or a project basis, directly be compensated for my clients and give them investment advice. I can't tell them what to buy in the end if the solution ends up being some kind of investment product. And so if we have these captive advisors who can only sell what's on the shelf behind them at the particular bank that they're at, or the mutual fund company that they're at, and we have these captive clients who can only get investment advice at their level from people who are these captive advisors, then that's where the regulations need to step in and fix it, because we need to end that.
And so I've just given you this magic wand here, and you can fix everything. You've only got like a minute, though, to use it, because I don't want you to have unlimited power forever. So what is it? What's the one thing you would do right away then to help fix this?
I would create a class of advice that's allowable under the regulations, that is checked by a compliance officer, the same standard of client care, better standard of client care, but the same standard of regulatory oversight for a group of fee-for-service investment advisors who can then say, I am now regulated, I've got somebody watching over me, all you need is the Vanguard all-in-one fund. Or, no, that's too simple for you, you need this other thing instead. Where they don't have to manage the client's money, they don't have to worry about, oh, well, you have less than $500,000, so I can't handle you. That it would be a new class of regulated advice.
So you are a CFP, right?
Mm-hmm.
Which means Certified Financial Planner. And I realize that in many provinces, you can call yourself a financial planner and it's not even a thing. But in your case, you actually took some courses and wrote some exams and actually know some stuff.
We hope.
We hope. So why do you need to be regulated then when you're already covered by this governing body?
Oh my goodness. Well, this governing body, just the same with the regulatory bodies, there is not every single trade, every single piece of advice standard of compliance. So it's not like, well, if they tell me something wrong, somebody's going to catch it. That's not how it works. Number one. Number two, there is no meaningful standard of advice delivery. There is no, if you get your CFP, you can deliver financial planning advice however you want to. You can call it a comprehensive plan and not include anything about their insurance coverage, for example. You can do whatever you want. So it does need to be regulated to some degree, because the people who are coming to us are people, we'll talk about this later, I'm sure, the people who have decided I need somebody outside of myself to give me advice about what to do with my money. Those people, if they knew what that standard of advice should be, might not need to come to an advisor to get it.
Well, so let's talk about that right now then. So why does someone need a financial planner? Why can't they just do this themselves? Why can't they do their own research, make their own spreadsheets, whatever? What is the point of paying? And let's assume it's a fee-only financial planner we're talking about. It's not somebody where fees are, buried somewhere. Right up front what you're getting, what you're paying for. Why? Why would someone need a financial planner?
Not everybody does. Actually, I'm sure most people who are really intelligent, all of our clients are super smart, engaged people. So it's not because they don't get it. And it's certainly not because the information isn't out there. If you look hard enough, and sometimes you don't have to look very hard at all, you can find the answer to most of the questions. Now, that being said, nobody has perfect objectivity about their own situation. So I know what I want out of life. I know what I want my life to feel like, but whether that means that my U.S. citizen husband really should then use a TFSA or not, maybe in this case, okay, let's go back one step. All these lovely, written out, well-researched blog posts about financial independence or whether the 4% rule actually applies or any of those things, every single one of them, the very first thing that somebody does after they read it is go, what about me? Because everybody has some unique thing about them. So again, people can find that stuff out. That's not hard. And I definitely don't want to say that everybody needs a financial plan, because a lot of people, there's very few people who, absent a financial plan, are going to fail miserably. Most people muddle their way through their lives without too much help from outside people. But if you do wonder, like I have 15 different things I could pay attention to. What are the most important ones? Or is it really important to pay attention to this one thing because I'm zooming in on how much I pay for groceries and maybe I need to be thinking about my house purchase or something instead? I don't know what the examples are, but having an objective third party that understands what your rules for success are and can apply all of those technical bits of information that we have about the way estates work or what a trust is going to do or what kind of insurance you really actually need. That's helpful. It's helpful to have a third party.
And I guess that's true of pretty much every area of life. Well, I could probably figure out how to do nutrition on my own. I can probably figure out how to, fix my car on my own. But having an expert help me through it just certainly shortens the learning curve, I would think, right off the bat.
Well, and nutrition and exercise are a really good example of a place where we know what the right thing to do is, but sometimes it's just helpful to have somebody that you've promised to do it to be accountable to.
So you're the person on their shoulder telling them, okay, let's keep an eye on this. So I'd like to talk about a couple of scenarios because, of course, this is Debt Free in 30. So we got to talk about debt here at some point. So if someone was to come to you and, you go through their numbers, help them start working on a financial plan, and that person has debt. Okay. And I'm going to make it that generic a question because obviously I understand there is a difference between somebody with $50,000 in credit card debt and $50,000 mortgage on $1 million home. Those are two completely different things. But let's keep it totally generic. So someone comes to you and you see that they've got debt. And let's just assume that in your mind, that's kind of at the top of the list, whether it's in their mind or not. But okay, that's a problem. What kind of advice are you going to give someone like that?
For the most part, if somebody has debt and we, in my mind or in kind of the team at Spring's mind, we've decided that needs to be number one. Given what this person is saying about what success is for them, this debt it's a priority. Most of the time we tell them that they either need to speak to our cash flow specialist. Before they can do any planning, it doesn't make sense to waste money on whether you should invest in an RRSP or a TFSA or not if you've got this debt that's a priority. But if the debt is a priority, we want them to talk to cash flow because cash flow is all about debt repayment and making sure that you're not filling in the debt hole and digging a new one on the other side with your habits and your lifestyle, right? You know that perfectly well.
Yeah, you got to stop the bleeding first.
Right?
Yep.
But if it's bad enough that we because of course professional advice comes at a fee. And so it's not to say, well, go off and fix your debt and then come back, because it's rarely that simple. But it's hard to have a conversation about why they should work with us if the bleeding is so heavy that it doesn't really matter what the plan is. They just have to deal with that first. So very frequently we'll send somebody, again, either to cash flow or to debt restructuring of some kind.
And deal with that problem. So, yeah, and obviously every situation is different. It could be that I was off work for a period of time. Now I'm back to work. So the thing that caused my debt isn't as big an issue, but you're going to get to the underlying issues then. So, well, let's take the other end of it then. So let's say that somebody has had a whole bunch of debt in the past. They've gone through a bankruptcy or a consumer proposal. They've now dealt with all their debt. Or maybe it's as simple as they've, paid it off themselves. They're now coming out the other end. So they're kind of starting from scratch. They're perhaps older. They're not 18 years old anymore. And they no longer have any debt, but they don't have any assets or anything else. They're starting over. What kind of advice would you be giving someone in that type of a scenario?
Oh, that's the most exciting advice. Blank slate advice is super exciting. So, I mean, you're not going to be surprised that the answer is it depends. But the first thing we assess, though, before
don't you have like a one size fits all plan? 10 points
right.
you just give to everybody and it's all exactly the same?
Oh, you're the number 3. Here you go.
Yes, here you go. Boom. I'm still going to charge you $5,000 for that, but here you go. So
here you go. No, so the first thing we need to do, though, is assess if they've really, I don't want to say learned a lesson is not the tone that we use. But if they're coming out of debt and they're a blank slate, there's a difference between somebody who's like, oh, finally I can do all the things I want to do because I don't have that payment I need to make anymore, and somebody who goes, oh man, that was really tough. Let's make sure that from now on we're doing things in a way that doesn't ever expose us to that situation again, right? And so with the one person, we're having very long conversations about what sort of really annoying boundaries we can put between them and overspending. And with the other kind of person, we are talking about, okay, so you can do anything and you've learned that lesson. So what does this look like now? What are the things that you want to guard against, number one? And number two, what does your life feel like now that you don't have that, and how can we give you more of that feeling?
Yeah, and that would be a pretty fun part of your job because, like you say, it is a totally blank slate that you're starting with. So I would assume another category in the blank slate area would be young families because obviously they don't have 20, 30 years of investments built up. They also perhaps don't have massive debt built up as well. And I mean, I understand that young families are one of your, favorite areas to deal with. What kind of issues do you see with young families and what kind of advice do you give them? What makes a young family different than, older families or single people or whatever?
Life cycle smoothing.
Life cycle smoothing.
We'll just add that to the list.
Yeah, that's another one there. Good. I like it. Yep.
So young families are bombarded with a lot of shoulds. And some of them, I mean, I have to say we, because of course I have a young family. I'm like 3 kids under the age of 10. Yeah, that's all this. No. But so we feel as though we have, this is very specifically where more goals than money as a phrase comes from. We feel like we have to be saving for our own retirement. We have to be aggressively paying down any debt that we have. So often, right, there's a mortgage or whatever. We also have to be saving for our kids' education. And then we have to deal with, oh, you need $5 for that run tomorrow? Oh, crap. Oh, my goodness, there's going to be a birthday party down the road and they put on big birthday parties. And now we feel like we should put on big birthday parties. There's so many shoulds on a young family, and they don't have the benefit of time. Often they're young people having young families, and they just haven't spent time learning about what's most important to them and how everybody else can just buzz right off.
And so that's your job, to tell them everyone else can just buzz right off. So
well, and also that's a beautiful time to help people really understand what they want out of their lives, because it feels really germane. Because when you have young kids, everybody's telling you, like, seize the moment. Oh, they're only young once. Those are true things. That's true. But so how do you use that information to stay sane? Because, oh my goodness, it's also super crazy. How do you stay sane and pick the things that are actually of value to you and the kind of family that you want to build? You're building something. It's brand new. So how do you, don't build it according to what the defaults are, or what your mother says you should do, or what the neighbor down the block does. You have a chance to build something that's just for you. I think that's get
pretty
really
exciting then.
Yeah.
That's why you like this job. You get to do fun stuff like that. So now there's another category. In fact, looking at your website, you guys have a book, a Women and Money ebook that's on your website, where you talk about, women need financial planning, unique challenges they face. And I think we're all somewhat familiar with those things. They've got a longer lifespan, more likely to perhaps have health challenges, whatever. Obviously taking time away for the 3 kids that you've got, and daycare and all those types of things. And that's very similar to a lot of the findings that we've come up with, in our Women in Debt study, why women file bankruptcy at a higher rate, why they have different debt levels and so on. So tell me a bit about your experience with that. So how do you guide women in particular in with financial advice? So whether they're single, whether they've got families or whatever, how is that different than perhaps the way you would advise a male?
It's interesting. So there are unique planning issues with many, not all, but many women. But as we talk about it in our team, I actually don't think that we speak to or plan with women in very different ways than we do with men, because the goal for us at Spring is not data in, plan out, now you're fixed. It's there's a lot of self-reflective work. And so when we work with women, and with men, but when we work with women and we talk about what success looks like for them, frequently the answer is different than we might expect if we were a different planning firm. I'm not totally sure how to state that, but given the opportunity, women can design pretty amazing kinds of success that aren't just about, I want to get to the VP position of X and that's what success in my life is going to look like. And I don't mean at all to intimate that that's what men think, but given the opportunity in a financial planning engagement to really reflect on what success means for them, is the whole foundation of the type of planning that we do. So whether you're a woman or a man, that's what we're going to be talking about anyway. And then of course we're going to bring in, well, if you are going to live a lot longer statistically than your partner, you get a chance to develop that vision of success again. And if you don't have a partner, you get to be the boss of that success, but you have to make sure that you've covered some bases that a lot of men who are going to maybe pass at age 86 don't have to think about. So it's not, I don't think we approach them that differently. It's just a couple of different topics tend to come up.
Yeah. So first of all, I'm going to die at age 86, so I got to write that down. So that's fine.
Mark that in the calendar.
I got a few. Well, that's okay. My birth certificate has a expiration date, as Stephen Wright once said. So it sounds like what you're saying is what you do for men and what you do for women is exactly the same. We got to look at goals, objectives, and whatnot. There may be a couple of extra layers for someone who's in a slightly different situation, I guess, is what you're saying. So yeah. Okay, so final question then. Investor education. We kind of, again, touched on a bit of this, but again, I'm thinking of my clients who have finished their bankruptcy, finished their proposal, things are now going good, they want to start putting some money away, and perhaps they, engage the help of a financial planner, perhaps they're trying to learn as much on their own as they can. In fact, I would say do both. Why not learn as much as you can and then have someone, also helping you? That seems like a good way to do it. What are your thoughts then on how people should, learn to be an investor? And maybe let's start with the real basic one, which was fees, which is where we started this conversation. So how can I decide if what I'm paying in fees, either to a financial planner or any other kind of investment professional, how do I know what's a reasonable range? What's a starting point to even think about that?
Oh, here's a really great starting point. You can get a regularly rebalanced, geographically diversified portfolio from Vanguard for less than 0.1%. That is going to do very well for let's just say, for lots of people. So let's say that's the baseline. So 0.1%, you can have all the securities are picked out for you. Everything's picked out for you. It's going to rebalance on its own. So that's
0.1% of however much is invested.
Of however much is invested, and
every year.
It's calculated sometimes daily and charged monthly sometimes. But as a good sort of rule of thumb, just say 0.1% per year on your balance.
Which sounds like a very low number. I mean, I know I'm a chartered accountant and everything, and I'm not that good at math, but if I do $100,000 times 0.0001, I guess, because it's 1/10 of 1%, you said. Mm-hmm. So I don't know, that's either $10 or $100. I think I probably did the math wrong. It's a very low number then. So, very okay. Low. So that's the starting point. And how do I continue thinking about that then?
Okay. So then what kinds of questions would you have? Aside from what should I invest in? What kinds of questions do people have for the person giving them? Now, here we're running the danger of conflating investment advice and financial planning advice because they are two very different things, even if only one person delivers them to you. But so for investor education, let's just say, what kinds of questions does a normal person have about their investments? And then you can tick off, where do I invest? How do I invest? How often do I rebalance? Any of those things, because it's done for you in this fund. So what is worth paying more than that? So, and remember, the average mutual fund in Canada costs upwards of 2%, and most of them are around 2.4%, let's say. So for 2.3% on your $100,000 every year, what do you need to get to feel like that's worth paying?
There's a big difference between 2.4% and 0.1%.
Pretty big. And this is relatively recent. I mean, 4 years ago, back in the fall of 2014, when the first few robo-advisors came out in Canada, and they were charging, their portfolios cost 0.2%, and then their fee on top of that might be 0.5%, somewhere in that range. So less than 1%. That was groundbreaking. 4 years ago, it was groundbreaking. And now we're at a point where Vanguard has all-in-one funds that, again, if you've totally filled up your RRSP room, you filled up your TFSA room, and now you've got a non-registered account, one all-in-one fund actually could probably do quite a good job for you anyway, but you might be into, okay, well, what do I hold in what account kinds of questions? And then, a robo-advisor might be worthwhile there, or somebody more than that. But we're kind of getting away from what investor education really is. But in terms of how much you pay and what you're paying for, that's again, that 2.3% difference between the rock bottom price and the average price, that's not even the highest price. That's a pretty big difference that could make a compounding difference of thousands and thousands and thousands of dollars over your lifetime of investing, even if you didn't have any of the other things right. If you put it in a TFSA instead of an RRSP, if you know what I mean? Like if you made a whole bunch of other wrong choices, but you saved yourself compounding thousands of dollars in your investments, those choices would be a little bit less wrong.
Oh yeah, it's a massive number. I mean, 1% of 100,000 is 1,000. So 1/10 of 1% is 100.
There we go. Now we're getting
there. We go. It took us a while, but we'll edit it out. It'll all sound great when it goes to air.
Smart.
Exactly. But so there's a huge difference between $100 and $2,400, and I'm assuming you've got a $100,000 portfolio. If it's more or less, then obviously it's different. So at a very basic level, that's certainly something to look at. And then I guess, take that money, and that might not be a bad idea to have someone helping you then with everything else. It's not just which stocks do I buy. As you say, there are low-cost ETFs that can pretty much do that for you. What you do is a lot more than that. It's, testing assumptions, it's education, it's, cash flow planning, changing behavior, all those kinds of things. So at what point, and I asked this question to Jason Heath as well when he was on, at what point then should someone, let's say they've finished their debt repayment plan, they've done their bankruptcy, done their proposal, paid it off on their own, they're now ready to start with they'd like to talk to a financial planner. At what point should they do that? Do they need to have a certain number of dollars in the bank? Do they need to have a certain number of dollars to invest in that process? At what point should they make the call to someone like you?
I want to say as early as possible. When you know that you are actually going to follow the advice. So that's number one. Because I worry that there are people who come to financial planning as a magic wand exercise. Like if I just know the answer to these 3 questions about RRSP versus TFSA or whatever, then I have a financial plan. I can tick that box and I can move on. And that's not to me, and I know not to Jason, what the exercise is for. So if you've done all the things, you've graduated, right? So now you're in, post-secondary financial world. You've paid off your debt and stuff. and you want to know how to build the scaffolding around the kind of life that you want, it means you know what kind of life you want. Maybe not all the way down to the specifics, but you need to know what the point of it all is. Or in my opinion, a financial plan isn't as useful as it could be if it's just kind of how do I make the most money out of life? Well, I don't know how you can make the most money. Sorry.
You don't? Okay.
I don't.
That was my last question. How do I make the most money out of life? And can you give us the lottery numbers? That would be awesome too. So, because I believe you're a big fan of buying lottery tickets. I think that's the foundation of all financial plans. So, okay. So what you're saying again, I think applies to all other professionals. The sooner you reach out for help, the better. And presumably if someone listening reaches out to you, you may say, well, you know what, there's a few things you got to do first, come back later, but at least they can have a preliminary discussion with you, or I don't know how you do it. You do most of your stuff exactly the way we're talking today, which is over the fancy interwebs here. That's the first step, reach out, and then you guys can figure out a plan from there.
Yeah. I mean, the beautiful thing is we don't want to work with somebody who is either not ready to work with us or isn't a good fit. And I think that's a good bar to set. And the other beautiful thing is I love talking to people about money. Mm-hmm. So it's not, nobody's obligated. It's not like we're going to send out hey, you spoke to a financial planner a month ago and are you ready to act now? It's never that. So having a conversation with somebody who's willing to listen and has some relevant background expertise can really help define for you if you are ready for that. I have no problem doing that. That's what we ask. We put all our clients through those paces, right? We take lots of notes. We write a long proposal letter to them that tells them what they told us and what we think we're supposed to be doing with them. And in some cases we say, no, it's not the right time, or no, we're not the right people. Here's a couple of people that you should speak to instead. Because the right fit matters.
And so you deal with people from all over the place.
I do. Geography
isn't a barrier then. So, okay. So how do people find you? Give us websites, Twitter handles,
so you find
us whatever you want to reveal here.
You find us by not looking for Spring Financial, which is a lending company. Don't look for them. And don't call us if they mess up your loan, because apparently they stink pretty much. And we get a lot of those calls.
We're getting sued. So send your emails to Sandi Martin if you don't like whatever those other guys are.
No, but so you can find us at springplans.ca. That's where kind of everything is centralized. I spend a fair amount of time on Twitter. So that's Sandi Martin SPF, I think.
Yes, it is that, and we've already played the clips there, so people will be jumping all over that. So
yeah, we teased that one
exactly. Sandi Martin SPF, so that's how they can find you there, and you already mentioned Twitter then, so those are the best places to get you. And then you've got whether it's explain to me what it is, a podcast, a thing where we can go online and see you talking with other people. How can we find that?
So that's at becausemoney.ca. It's
becausemoney.ca.
Yeah, we're just starting season 5. It's very exciting.
Well, and this is season 5 of Debt Free in 32. So there you go. So there's a lot of laughing I saw on the episodes. You guys seem to have a good time when you do that.
It's super fun, and we actually have moved. We're only going audio for season 5.
Oh my goodness!
I know, but there's still going to be a lot of laughing. I mean, I laugh quite loudly, so I don't think anybody's gonna. You can't miss it.
Yeah, well, and no one's offended by laughter, so that's excellent. So, are there any final words of advice then you want to leave people with? I think we've covered a lot of ground there, but is it as simple as reach out if you're thinking? What are your final pieces of wisdom?
Develop your reflective IQ. Really think about what's happening inside and what's important to you. And then reaching out professionals is great, but the first person you have to really understand is yourself.
Wow. That's pretty hard.
It's super hard. Oh my word. It sounds so easy, doesn't it? Oh yeah. Develop your reflective IQ. Man, spending time navel gazing, most people don't really enjoy it, but the benefits are very extreme, actually.
And so if that's what I want to do, what's the first step in that? Do I lock myself in a room for a couple of hours? Do I go for a walk? Like, how do I jumpstart that reflective IQ process?
That's a really good question. I would actually say, something that the Spring team is going through right now, and a couple of the planners actually in that Twitter thread, in a forum that we have, is a book called Designing Your Life. So it's applying design thinking to not just your work life or your money. It doesn't even specifically talk about money, but it's a set of tools to really think about the things that bring you fulfillment and the things that don't, and you just do because it's obligation, or you don't know that you have any opportunity to make any other choices. So it's a good book to start with.
Excellent. Well, so there's some practical ideas to get started. Excellent. Sandi, thanks very much for being here.
It's been my sincere pleasure.
Excellent. Well, that was my conversation with Sandi Martin, a financial planner and co-founder of Spring Financial Planning. Full show notes, including links to Sandi's website and a link to her big tweet storm on June 22nd, and everything we talked about today, and a full transcript of today's show can be found at hoyes.com. That's HOYES.com. This podcast is available on iTunes and all major podcasting apps and on Stitcher, and you can watch the video on YouTube on the Debt Free in 30 channel. That's our show for today. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.